Hello, everyone, and welcome to the quarterly Cliffwater Asset Allocation webinar. My name is Phil Huber, Head of Portfolio Solutions at Cliffwater, and momentarily you'll be hearing from Cliffwater founder and CEO Steve Nesbitt. A few quick notes before we get started today. You're welcome. This webinar is intended for research purposes only and is not specific to any Cliffwater funds. So you're welcome to submit whatever questions you'd like throughout. We'll address them towards the end, but just know that any fund-specific questions will need to be addressed offline. Secondly, a copy of today's slides should be in your inbox. We sent a reminder email about 15 minutes ago. It should also be downloadable from the web portal as well here. So everyone will have a copy of those. With that, I will hand things over to Steve.
Hey, thanks, Phil, and thanks everybody for joining us today. Pretty straightforward agenda, mostly focused on top-down investment items, including the macroeconomy, government policy, how that affects the capital markets. Then I'd like to talk about our baseline expectations for the individual asset classes, kind of combine that with his historical returns on the individual asset classes. And then move on to our model portfolio, the results for that, and then open it up for Q&A. So let me get started by first talking about the real economy. Here I'm showing quarterly GDP going back approximately 35 years. The 90s were a great period for the US economy, 3.4%. Not so much the following decade. Remember, we had two recessions, great financial crisis, and the 2000-2002 recession. Growth was 1.7%. Got back on track after the financial crisis, 2.4%. We hit a divot in COVID. All combined, GDP grew 3.7%, but it was a wild ride. Anyway, more normal conditions post-COVID. Good, not great, 2.3%. The last print, first quarter of 2026, 2.1% real growth rate. So basically, the U.S. economy it has been pretty consistent at somewhere between 2 and 3%. I may call that not great, but comparatively, if you look at the next slide, it's better than all other developed markets. So here we're showing the growth rate post financial crisis in that dark line at the top for the U.S. economy, growing at 2.5% over this measurement period. Canada is very close. Generally, so goes the U.S., so goes Canada. The rest of the developed world, though, is pretty disappointing and continues to be disappointing. That's important to understand when we look at capital market returns outside the U.S. Speaking to government policy, with both monetary and fiscal policy, obviously both are important in helping stimulate or discourage economic growth. So here we show monetary policy, which has been kind of up and down, stimulative and restrictive, but currently stimulative with the growth of inflation. So we're showing here, historically, going back post-World War II, the Fed funds rate and the inflation rate in red, Fed funds in blue, the difference being real interest rates. If you look on the shaded area, positive numbers means it's restrictive, more restrictive, and negative numbers means it's a stimulative or accommodative policy. We had been dealing with a restrictive period over the last couple of years with interest rates up relative to inflation. Obviously, the Iran war, reversed that. We now have a negative real interest rate minus 29 basis points. So basically, Fed policy is because of the higher inflation accommodative. Everybody, not everybody, but the pundits are looking at, and the forward curve is looking at perhaps an increase in Fed funds rate this year. I think the forecast is for one rate increase. We'll see, but basically, perhaps it's just justified given the rate of inflation. Okay, the average, if you look at the bottom, the average Fed funds rate relative to CPI, the spread averages 1%. So that's what we call normal, but currently it's negative. So again, accommodative or stimulative. Turn to the next slide. Fed policy, I stole these two graphs from the Congressional Budget Office, but basically fiscal policy has been and remains stimulative. In that top graph are projected annual deficits. As you can note, post 2026, the interest on existing debt is going to comprise a good portion of the deficit. There's no escaping that. The primary deficit, though, looks to be pretty stable. But again, annual deficits accumulate, and that accumulation is shown in the bottom graph, where currently we're looking at debt as a percentage of GDP just over 100%. That's expected to grow and reach 120% over the next 10 years. So whether investors get comfortable with that or not over the years to come, we'll find out. But it's definitely becoming more and more significant. Anyway, with that as a backdrop, and looking at the Fed's support or lack of support for the economy, and again, right now it looks more supportive than that. Just wanted to talk about the most important capital market in the U.S., and that's the stock market. And I've shown this graph updated, of course, over and over again, and it basically said you really don't want to bet against U.S. stocks. Again, a lot of advisors, analysts, pundits, whatever, who fear U.S. valuations and so forth. But there's been an unbelievable record of capital formation for the U.S. stock market. I go back over 100 years in this graph. The scale is logarithmic, so a straight line is a constant compound rate of return. So for U.S. stocks, that compound rate of return has been 10.6%. Okay, part of that has been PE expansion of about 1%. So if you subtract 1%, you get 9.6%. Again, just below 10% has been the nominal growth in U.S. stocks. And look, we've had some slow decades, but there's always a recovery, and this long-term record is really truly impressive, and really can't find any place else across the world economies. Importantly, bonds have performed 4.8% over the same period. So I show this because I want to say that the difference between stocks and bonds has been 6%. If you subtract that PE expansion, it's more like 5%, stocks versus bonds. And keep that in the back of your mind. I'm going to come back to that. Bonds on average perform about 1.5% better than cash. Cash came in at 3.3%. Inflation 2.8% over this period. Cash has produced a small real return, or inflation a modest inflation adjusted return of about 0.5%. These relationships kind of vary depending upon your endpoint, but they've been pretty consistent over the last 100 years. People are again, some are very concerned about overvaluation of the stock in this stock market. That impacts our expected return on stocks. I've always been a little bit amazed by the consultant community, investment banking community, that have put really pretty low expected returns on U.S. stocks, really, but primarily because they believe the PE ratios are too high, growth rates are too high, et cetera. My own feeling is I think they are betting on the U.S. stock market. But I think basically U.S. stocks perform in line with their fundamentals. So this is a graph I haven't shown before, so let me spend just a couple of minutes on it. So this is earnings per share for the S&P 500 over this 100-year period. So that is shown, again, it's a log scale. This is shown the blue line. Obviously, earnings per share varies. There are drawdowns, Great Depression, financial crisis, et cetera. But basically, it's a pretty consistent growth rate at 5.9%. There's been an acceleration over the last 10 years. Earnings growth has been 11% over the last 10 years. That likely explains very strong performance post-financial crisis in the S&P 500. We're expecting that to continue this year. So the forecast this year, if you look at the upper right for S&P earnings, is $338 per share. Last year was $270. So that's about a 25% expected increase. So again, the very good stock market is quite honestly fully explained by growth rate in earnings per share. I mean, we may maybe get concerned about what types of companies are contributing to that growth, but there's no question that price increases are fully supported by earnings growth. I show an equation at the bottom of this page. So basically, this is kind of simple stock math, that the return, whether it's an index or a security, equals its dividend yield plus its earnings growth plus or minus PE expansion, or if it's negative, contraction. So I take this formula, apply it to this 100 plus years, and from the prior page, I showed you 10.6% for the entire period. That's broken down into three components. The dividend yield on average over this entire period has been 3.7. Earnings growth, as we talked about on the prior page, 5.9%, plus earnings plus PE expansion, 1%. So you add those three components, and the math works. 10.6 equals 10.6. People may be a little bit surprised by that 3.7% dividend yield, and you may say, "Oh, that's pretty high." That may be true historically, but right now we're looking at 1.5 to 2% dividend yield. I think it's more like 1.5 for the S&P 500 today. But actually, if you adjust for stock buybacks which were not a thing until 10, 15 years ago. Basically, the cash flow distribution by S&P companies to shareholders is about 3.7%. If you adjust the dividend yield for those share buybacks, you also have to adjust earnings growth down. But earnings growth, as I'll show you in just a second, has been double digit for the S&P 500 in recent years. I can't say that there'll be further PE expansion, but basically I believe this equation works not only over the entire 100-year period, but it also works over more recent periods, and I believe so on a go-forward basis. Talking about the non-US markets. So here I'm showing the performance of non-US stocks. Non-US stocks have had some recovery over the last year and a half, but basically they've underperformed US stocks over the last 10, 20, and going back from really their inception, or at least the index inception in the mid 1980s. So this whole issue of non-US diversification, our position has always been that just you need to think about this because it's not necessarily that non-US stocks will perform in line with US stocks or even do better. Underlying fundamentals suggest otherwise, but also the diversification really hasn't been there. Correlation between US and non-US stocks has been pretty significant. So let me just amplify on this. So what I've done here is provided a little more updated data on stock fundamentals. What I'm showing here on the top table, I did this last quarter. So this is a replication of last quarter, the top table. Basically, I had shown that US growth rates had been really compounding over the last 15 years at twice the non-US growth rates, at least in terms of EBITDA and net income. I just wanted to show that continued in 2024, 2024 and 25. If you look at the shaded, so let's look at EBITDA. That's my preferred measure. But basically, we've been dealing with double-digit EBITDA growth in the US, 11.6 in 2024, 10.9 in 25, compared to basically flat for non-US stocks, 40 basis points and 1.6%. On the right-hand side, I also showed basically, but non-US stocks in 24 and 25, at their PE ratios had been expanding. If you look at non-US from 6.2 to 8, US basically modest increase, 14 to 14.7. So there had been some catch up in the last 2 years in non-US stocks, but it wasn't because of earnings. It was primarily because of PE expansion. That actually proved prescient. If you look at the bottom table, which is new, I'm showing the EBITDA growth. Again, at least my preferred measure of overall growth, capital formation of US companies. I show that for the quarter. So let me walk through this table. So on the US, that first row, okay, we have 100% reporting for the first quarter, okay, 500 companies, showing earnings growth for Q1 over the fourth quarter of 25, so quarter over quarter, excuse me, quarter to quarter, 5.2%. That is a quarterly number. So if you annualize that, that would be over 20%. So really pretty good. And if you look down to the subcomponents, I show three. Actually, the MAG 7 was pretty modest. It was slightly negative, minus 1.6%. I think that had a lot to do with AI spending. X the MAG 7, 7.4%, which excellent if you annualize it. And I also broke out software. Software both in and out of the S&P 500 companies. There are 126 companies, publicly traded companies. I think I put a minimum size on this, but 126 software companies. And again, everybody, the narrative out there is AI is going to destroy software. But at least in the first quarter, EBITDA growth for software companies was 8.1%. Annualize that, you're dealing with 30%. So far so good. We'll see. And I also wanted to show, however, that the first quarter was a pretty bad quarter for stocks, at least U.S. stocks, and that's shown here. Basically, the price to EBITDA decline for U.S. stocks. A lot of this decline had to do with the Iran war. Let's look at non-U.S. stocks. Again, if we look at 2024, 25, their PE ratios expanded. And you can see EBITDA growth, that middle column, again, quarter one over quarter four, again, unannualized. We're really pretty impressive. I will say that reporting is still, in total for non-US, only at 72%. A lot of companies only report twice a year, so it's really hard to get current data, at least on an aggregate basis. The best was the UK, but really only 10 companies reported, and one of them was a large oil company. Emerging markets, though, we got 91%, 50% growth. Again, the growth rates, EBITDA growth rates outside the US have finally started to rebound, which is supporting their increase in price. With that as a background, it's sorry to spend so much time on that, but it's the largest asset class in most everybody's portfolio, public equities. This is our baseline expectations for asset class returns based on long-term historical averages. So we always start with inflation, 2.5%, just as a rough starting point. We expect cash rates to offer another 0.5%. Moving up this first bar, we expect bonds to produce treasury bonds to produce an extra 1.5% over treasury bills, stocks 3.5%, and private equity another 3%. Turning to the next bar, public credit, like the Morningstar Leveraged Loan Index produced 2.5%, private another 4%, and so far and so on to the right. These are historical excess returns that are pretty stable over a long period of time. And so what we're looking for is differences from these expectations that might inform us that, hey, something looks attractive or something does not look attractive. I will say, just to get to the bottom line, basically we feel that most of the asset classes are pretty much at equilibrium. That is, if you look at today's forecast versus this baseline backdrop, our numbers are pretty close. I think the only exception here, maybe two exceptions, the treasury bonds are not quite at that 1.5%. So we wouldn't be a little bit hesitant about long-term treasuries, and also high-yield bonds that are not our expected returns are not at that 2.5% delta over treasury bonds. Might be a little bit concerned about that, but everything else seems to be pretty much in line with our expectation. Let me move on. I'm going to skip this. I think you're all familiar with that, and spend just a little bit of time on this pretty detailed slide. In the first column, or second column, I show the year-to-date 2026 returns for these individual asset classes. As you read down, I won't go through these, but as you read down on the alts, on the private equity, private real estate, private debt, we don't have numbers through June, so I'm showing trailing 4 quarters ending March 31. But I'd like to focus on the 10-year expected returns, and try to show you why I think they're pretty much in line with our long-term baseline expectations. So we're looking at S&P 500 at 8%. We show how we put that together in the last column, for right-hand column. But that 8% is about 3.5% better than 10-year Treasury. That's consistent with our long-term expectation. It's a little bit low against Treasury bills. So Treasury bills are at 3.25 expectation. So that's a little bit less than 5%. And excuse me, a little bit less than, yeah, it's a little bit less than 5%. So it's a little thin, but not overly so in our opinion. But basically, if you look at credit, the Morningstar LSTA, so leveraged loans are pretty consistent with our baseline expectation. High yield bonds, we would hope for a little bit more than 5.95 because you're taking duration risk, and that duration risk is getting paid over 1%. That doesn't seem to be fully transformed into the high yield bond return. If you look down, let's move to private equity. Again, our private equity expectation at 11 is again 3%. That's consistent with our baseline. Private real estate transaction cap rates have now got to a level that we think are at or are close to kind of equilibrium, given our expectation for the rate of inflation. We're again starting to become very constructive on equity real estate. Private debt, pretty much the same numbers as last quarter. Again, we think this private debt offers a significant premium just over public equivalents, just as private equity and private real estate do. So we're still very constructive on private alts. And again, these other asset classes, whether it's oil, gold, Bitcoin, et cetera, basically we don't assume any real return on these asset classes. I've shown this in past quarters. So basically, if we look at kind of consensus forecast for individual asset classes, consensus defined as the average of what other very large allocators put together in terms of their expected returns. The one obvious asset class that continues to stand out is private debt. And there's been a lot in the press on, oh, gee, all this institutional money is going into private debt. surprise, surprise. Well, it's been no surprise if you've been listening to our prior asset allocation presentations. Forecasts for private debt are very constructive by institutional consultants and large institutional money managers. But and our view is very consistent with that. What we differ quite a bit on is the institutional forecast for U.S. stocks is very low at 6%. Again, we're not of the same mind, and we're at the higher end of the forecast range for U.S. stocks because basically, I think we're more optimistic about the fundamentals, and we don't see PEs converge from the 20s back down to the teens for U.S. stocks, particularly given the growth rates. And here we're showing individual forecasts by the 15 advisors and the distribution of those forecasts. Again, what pops up is private debt and private equity. Key here is, overall, people talk about the 60-40 mix, 70-30 mix. Basically, we have tracked the spread between our expected return on U.S. stocks and treasuries over a very long period of time. I did this at the start of my career back in the late 70s, and have noted how that spread has changed. If you look at the shaded area, that can get wide or that can get pretty narrow. Until about a few years ago, we were very constructive on stocks because the yields on treasuries were so low that made spreads very high. Bottom line today, spreads at the if you look at the far right-hand side of this graph, 3.52%. That is basically at the long-term average of 3.48%. So basically, if I'm managing something to a 60-40 or 70-30, I'm not inclined to tilt more towards equity or less towards equity based on current valuations. And finally, let me just wrap up here. We're at the bottom of the hour with our model portfolio. So get to the bottom line. The model portfolio, since we introduced this in 2023, exactly 15.0% annualized return. We show what that's comprised of. Basically, we're using ETFs and interval funds. And the benchmark is 13.8%. So we're up by 1.2%. And that's very consistent with what Cliffwater has preached. What has it preached? It said that, hey, if you invest in private alternatives, okay, whether it's equity, real estate, or debt, you can expect a 3% delta over the public equivalent. Right? So 3%, if you have an allocation of roughly a third, okay, a third times 3%, basically 1%, okay? So you should expect a 1% delta. And here we have 35%, not at 33.3, but 35%. So the performance, admittedly short, but it's very consistent with our investment thesis. So with that, thanks for your patience and attention. Let me turn it back to Phil to propose any questions.
Great. Thank you, Steve. Why don't we, if you want to go back to, I think it was slide 8, you had the return equation with dividend yield and earnings growth, et cetera. Question came in wondering about dividends since they are paid out of earnings. Are you not counting dividends twice? Is the question.
No, well, No. So this is the current, basically it's the current dividend yield plus the growth in earnings. This is the old Gordon model. So you start with the dividend yield, okay? And then you assume we add earnings growth because basically dividend growth will pretty much match earnings growth over time. So it's not double counting. Okay, in any one period, you have earnings and dividends come out of earnings, but that's that is a single period. Over time, earnings growth will expand future dividends, and simplifying that equation, as Gordon did, basically get the current dividend yield plus earnings growth.
Thank you, Steve. The next one, if you go to slide 10, I believe, with the various fundamentals and valuations for software, Mag 7, broad markets, et cetera. Short and sweet question from the viewer here, but so is software undervalued based on what you see there?
Don't know is the question. The price to, if you look at the price to EBITDA for software, 30 and 26.9, they are higher PE ratios, kind of consistent with software. You can look at the Mag 7, you'll see the same higher earnings growth and higher PE. So software is kind of trading, at least calendar year wise, consistent with the Mag 7. If you look at down below quarter over quarter, the last print we have on software price to EBITDA is 17. Okay, if you're looking at growth of 8.1, if you think that's going to continue, if you annualize 8.1, you get 32. It is undervalued. So this all comes down to the AI, your forecast for the AI impact on software. So what I've said is, so far we don't see it. Okay, and maybe it'll materialize. If you think software, the fundamentals are going to stay close to where they are now with growth, it is undervalued.
Great, thanks, Steve. I think you'll like this next one because I know you've written about this topic a few months back. Steve, can you comment on your views on this asset allocation process versus the TPA or total portfolio approach?
Well,
and just maybe your general thoughts on TPA.
Yeah. So basically, what I've said is the traditional asset allocation approach, where you define asset classes, okay, define return and risk for individual asset classes, do a risk assessment, what's your attitude towards risk, optimize a portfolio. It gives you basically a portfolio that should be optimal over a long period of time with defined allocations to each of the asset classes, and then in terms of implementation, it's in implementation, I got my strategic plan. Let's try to see how well we are at implementing. Okay, and against that, formulaic asset allocation. Okay, 60-40, whatever. So what's great about the traditional asset allocation approach, they call it strategic asset allocation, is you can measure implementation. Okay, You can measure how well you're implementing equity. You can measure how well you're implementing fixed income, et cetera, et cetera, et cetera. And then you can have different subcomponents. So it's a way to measure implementation, okay? With TPA, I don't know, how do you measure implementation? I have no idea. Basically, they say, hey, we have an overall goal. And I don't know, CalPERS is leading this. I think it's 70-30 goal, okay? So the question becomes, okay, that's your goal. Let's say you outperform it. I hope they outperform it. I mean, it's easy to outperform over time. But if you underperform or outperform, it's not, particularly if you underperform, how do you know who's at fault? It's very difficult to measure success or failure under this approach, and I also think it's very difficult to measure success. Even if you outperform, you don't know what. It's hard to determine whether it's luck or skill. And what I wrote about was I've been in the business long enough that I remember the 1970s, where basically you gave your money to a bank, like JP Morgan, they would manage it and it'd be a balanced portfolio. But you could never really identify why JP Morgan underperformed or not. And it becomes very amorphous. So one thing I will say is the old approach, strategic asset allocation, has worked very well, particularly at the institutional level. I think it also works at a wealth level, has worked for a long period of time, okay? I just don't see how TPA or total portfolio TPA, I think it's, so far what I read, I can't understand. So it's like, okay, AI, well, let's understand AI's impact on the total portfolio. Okay, let's do that, but how are you going to make decisions out of that, and who's going to be accountable? I don't know. So good luck. Well, there'll be a good litmus test.
Mm-hmm. Let's talk about IPOs. We're a few weeks post the SpaceX IPO, and it seems like there's a pipeline of some other very large private companies to the scale that we've never really seen before enter public markets. How do you think about new supply of IPOs into public markets, and what impact that may or may not have on future expected returns for stocks? And particularly given the scale, is there any worries that given the types of companies that are coming to market and their focus on AI, is that going to further concentrate the market in terms of broad exposure to a particular theme?
Yeah, so I think it's both good and bad. I think the positive is, these companies have created tremendous wealth, okay? And that wealth is being transferred to the part of that wealth. The IPOs maybe 10% of shares out. So, but part of that wealth is being transferred to public investors, greater access to those types of companies. In the same way, I think a couple decades ago, Google and so forth started to go public. And so I think, that's a real good thing, basically giving public investors the chance to participate in subsequent growth. So I think that's all a good thing. The risk, or the thing you want to think about, I'm not sure it's a risk, is the market's going to be more concentrated in technology. Okay, this time more in the form of AI. That's something that I think from an asset allocation point of view, you definitely need to think about becomes more industry, U.S. is going to become more industry concentrated. That may be a good or a bad thing. It will probably mean you need to think about it in terms of your asset allocation. Do I want my 60% to be 50% of my 60% to be technology? I think that's something that's going to have to be considered in overall asset allocation. But I see both. Basically, I see it as a positive for the overall U.S. economy. And it's going to stimulate innovation and further growth. But in terms of investment management, it's definitely something from a risk point of view you need to think about it.
Let's shift a little bit to direct lending. A few kind of questions around this topic. First off, interest rates. We're not obviously in the business of predicting what the Fed's going to do, but right now the market's assigning a pretty strong probability to a rate hike before year end. I think investors in this asset class, given its floating rate nature, understand, rates go up, yields go up, rates go down, yields go down. How do you think about it from the standpoint of borrower health, though? Like, should investors hope for higher rates in higher yields? Like, how do you think about that relationship, not just from a return lens, but also a risk lens when it comes to borrower ability to, maintain interest coverage, that sort of thing?
Well, I think right now, if you look at the private equity world, I think they're much more attuned to interest rate risk. That they're no longer comfortable at 0%. I think they know, rates are going to be at least short-term rates are going to be in the 3.5% to 4.5%, in the 3% to 4.5% range, I would say. And basically, valuations have adjusted. Private valuations have adjusted to that realization. So, I think managements through liability management, whether that's hedging or some other means, are not going to be caught by surprise as they were in 2022, by rates suddenly going from 0 to 5.5%. So I'm not so worried about it myself. I'm not so worried about 0.5% or a 25 basis point or a 50 basis point rise. I don't think it'll have put any added pressure on private companies.
Okay. We'll talk about everyone's favorite topic now, which is repurchases from private credit funds, interval funds, BDCs. That seems to get a ton of press today. A lot of these articles have failed to talk about performance, which has remained, relatively pretty strong. An interesting data point came out this week around institutional flows into direct lending funds. In the second quarter of this year, according to Preqin, $16 billion was raised, and that was the second highest quarter in like 4 years. So that's a very different dynamic relative to what most people are reading about as it relates to the wealth channel or retail, if you will. And how do you think about the different behavior taking place? What does the mix of dollars look like within private debt in terms of institutional versus retail, and how to sort of reconcile that difference?
Well, the institutional market has slow and steady, has recognized the value of private debt, private credit, and really over the last 5 years, it's kind of accelerated over the last couple of years, have increased their allocations, so become new allocations to private debt. They don't invest it all at once. They stage their investments. So this money that is coming from institutions into private debt, this has been baked in for 8 to 12 quarters. So this money has been coming. It's been targeted, and it should be fully expected. So, but no one should be surprised by the institutional money coming into a private debt. And I showed it on a prior table, a prior slide. this graph is the reason money is going into private debt. The wealth channel or the retail channel, they're just entirely spooked by a press frenzy on trying to find everything bad about private debt or private credit. So if I don't know a lot about what's going on, I'm just reading all these negative articles on private credit. I'm not at all surprised that redemption amounts are up, and it's like, hey, let me be safe. Let me get out. I can always get back in. So, bottom line, as long as the underlying fundamentals of private debt remain reasonable, and they have been.
Is that fear, is that behavior showing up yet in any data that you've come across as it relates to spreads on new deals or documents becoming tighter, et cetera, for those?
Well,
that
yeah,
are
a little bit.
Yeah,
It's so you'll read it. Institutions see greater opportunity. This is not a dislocation. Okay, a dislocation would be spreads, widening by 200 basis points or something like that. We've seen some spread widening of 50 to 100 basis points, a little bit better in terms of covenants. So there is, I would call, an adjustment. Okay, investing today is better than it was 6 or 12 months ago. But it's not a huge dislocation, and the reason it's not is the fundamentals really haven't changed. Okay, and loss rates are way down. PIK actually went down quarter over quarter, and the market's pretty efficient. And anyway.
Okay. The Shiller Cape ratio, it's kind of it's approaching its 2000 level. 2000 levels. Does that metric worry you at all? Is that something you think a lot about, Shiller Cape?
No, I don't look at it because I know it's, everybody looks at it, but I always get frustrated with it because it looks at earnings in hindsight. Okay, it's not pricing forward earnings, so the denominator always strikes me as too small. So anyway, I don't. This is not in 2000. If you look at internet companies in 2000, okay, the internet bubble, if you put all internet companies together, okay, they had negative earnings. Okay, so you did not have a PE ratio because there are no earnings. Okay, but here, if you look at software, if you look at Mag 7, you're looking at significant earnings, and you're looking at significant earnings growth. So to me, it's apples and oranges.
Well, I think too, if you're only investing based on when the Shiller Cape was below its long-term average, you'd be sitting on the sidelines for much of the last 20, 25 years.
Well, yeah, that's the problem with value investing. All due respect to value investors, and they always have their day. But if you look at historic based measures, you're going to be out of the market more than you're going to be in.
Great. Well, I think that's probably a good place to pause for this webinar. We want to thank everyone for joining here today. Thank you, Steve, for your insights. We hope everyone's having a great summer and continues to do so. And we'll look forward to seeing you all in the early fall. So anything else, Steve, you want to add before we sign off?
No, I really appreciate you joining today. Please reach out if you have any questions. Thank you.
Thanks.